When you picture a central bank, you probably don't picture a massive profit machine. But right now, the Reserve Bank of India is preparing to hand over a record-breaking dividend to the Indian government. The RBI operates as a regulator, mandated to stabilize prices and manage the nation's currency flow. This multi-billion-dollar surplus is a byproduct of its policy actions rather than traditional commercial sales. But the government is currently facing a massive external shock. The escalating crisis in West Asia has sent energy costs soaring, putting tremendous pressure on state finances. To absorb that macroeconomic shock and keep domestic prices from spiraling, the government needs cash, and they are looking directly at the central bank's vaults to get it. State-owned companies are currently losing an estimated 1,600 to 1,700 crore rupees every single day just to import oil. When you're facing a daily deficit that large, the political temptation to simply demand a cut of the RBI's existing surplus to plug the holes becomes a focal point of government strategy. But history shows the risks of this approach. A few years ago, a similar demand for cash triggered a severe institutional crisis, putting then-Governor Urjit Patel in a direct standoff with the state. Treating a nation's central bank like a political piggy bank threatens to compromise the financial independence required to keep the broader economy stable. This diagram shows exactly how a central bank stockpiles billions without a consumer product. On one side, we have income streams, and on the other, reserves. The first revenue stream comes from lending directly to commercial banks and collecting interest. Next are government securities, or GSECs. When the state borrows money, the RBI provides the capital and earns interest on the government's own debt. But the largest stream typically comes from foreign exchange, or forex reserves. As the US dollar strengthens against the Indian rupee, the raw value of the RBI's massive dollar holdings automatically increases on the ledger. When you pool these three streams together, you get a verified surplus sitting at the bottom of the bank's accounts. The RBI generates this wealth as a result of maintaining economic equilibrium. However, that stockpile of cash makes it a frequent target for a government facing budget shortfalls. During the 2018-2019 financial year, the government pressured the RBI to hand over up to 3 lakh crore rupees from its reserves. Governor Urjit Patel refused. He argued that draining those specific emergency reserves would leave the Indian economy vulnerable to future global shocks. In response, the government considered invoking Section 7 of the RBI Act. This is a rarely used legal power that allows the state to issue direct orders to the bank, effectively overriding its autonomy. Rather than comply, Patel resigned in protest. His exit triggered widespread concern across the financial sector regarding the long-term independence of the bank. To resolve the impasse, the government formed a specialized panel led by former Governor Bimal Jalan. The 2018 clash highlighted the friction between short-term political needs and long-term institutional caution, making it clear that a new, predictable framework was necessary. The Jalan Committee resolved the conflict by creating a strict formula. First, the bank fills a contingent risk buffer, reserving 5.5 to 6.5% of its balance sheet for emergencies. Under Section 47, only surplus spilling over this safety buffer is transferred as a dividend. By replacing a subjective political argument with a mathematical rule, the RBI protected its reserves while still providing a mechanism to support the state treasury. Today, the current record-breaking dividend is flowing because the RBI's strict safety buffers were met first. This process is standard for major economies. For example, the U.S. Federal Reserve, the Bank of Japan, and the People's Bank of China all legally remit surplus funds to their national governments. This dividend acts as a macroeconomic shock absorber. It is a calculated balance, providing the state with significant capital during a crisis without depleting the reserves the bank needs to protect the nation's financial future.